Hello everyone and welcome back to the channel. This is the place where I break down the principles of value investing to help you invest in quality companies for the long term. For those who are new to the channel, my name is Anand. I am a software engineer turned quality value investor managing my own portfolio for the last 7 years. If you have spent any time in the value investing community, you have probably been trained to look for one holy grail metric called ROCE, Return on Capital Employed, or its cousin, ROIC, Return on Invested Capital. We are taught to search for businesses that generate 30, 40, or even 50% returns on their capital, believing that this metric alone is the key to finding long-term compounders. But today, I want to show you why that is a trap. High ROCE alone is simply not enough. In fact, if you only look at ROCE, you are only looking at one side of the engine. The second side, the side that most investors completely ignore, is the reinvestment rate. To build a true wealth compounding machine, you need both sides running together. Today, we are going to look at the first principles math behind what I call the twin engines of compounding. And then we will compare two household names stocks on LVI to show this in action. And then finally close with a fascinating paradox about Apple stock, ticker AAPL, that will test how you look at capital allocation. Before we look at the business itself, let us look at how we actually make money in the stock market. Over a long period, your total stock return comes from three simple engines. First, capital distribution. This is the cash the company directly returns to you through dividends or share buybacks. Second, valuation changes. This is when the market sentiment shifts and the P multiple expands or contracts. For example, a stock's valuation expanding from 15 times earnings to 20 times earnings. And third, the fundamental growth. The organic compounding of the business's earnings. If you hold a stock for a short period, say 1 to 3 years, changes in the P multiple dominates your returns. This is what classic value investors focus on, buying a stock cheap and selling it once the valuation gap closes. But if you are a quality value investor like me, looking to buy and hold outstanding businesses for 5, 10 or even 15 years, multiple expansion fades into the background. Instead, earnings growth becomes the absolute driver of your long-term returns. Let me show you the math of how multiple expansion fades over time. Let us look at a concrete example. Suppose you buy a stock that pays a steady 2% dividend yield, grows its earnings organically at 10% per year, and experiences multiple expansion with its P ratio expanding from 15 to 20 once during your holding period. If you hold that stock for 5 years, the earnings grows by 10% compounded, which is 1.61 times starting earnings. The P expansion from 15 to 20 increases the stock value by 1.33 times. And multiplying those together, the stock price grows to 2.15 times your starting price, representing a 16.5% price CAGR. Add your 2% dividend and you get an 18.5% total annual return. In this 5-year period, multiple expansion was a huge contributor, adding roughly 6.5% to our annual returns, calculated additively as 16.5% price CAGR minus 10% organic earnings growth. Compounded, the PE expansion from 15 to 20 over 5 years grew at an annual rate of 5.92% CAGR. But look at what happens if you hold the same stock for 15 years. Assuming the PE still expands from 15 to 20 once and stays there. Your earnings grow at 10% for 15 years, compounding to 4.18 times your starting earnings. The stock price ends up at 5.57 times the starting price, which is nothing but 4.18 times 1.33. This basically represents a 12.2% price CAGR. And then adding your 2% dividend gives you a 14.2% total annual return. Notice what happened here. Over 15 years, the contribution of that PE expansion to your annual return dropped from 6.5% to just 2.2%. The longer your holding period, the more your total return converges directly onto the fundamental business engine. That is earnings growth plus dividend. So the next logical question is, how does a business actually build sustainable organic earnings growth? Before we look at any corporate spreadsheets, let us connect this directly to our own personal finances because the math is identical. Imagine a software engineer earning a high salary of $200,000 per year. This high income represents their ROCE. They are generating a very high return on their human capital. But what if this engineer spends 95% of what they earn on rent, fine dining, vacation, and new cars? Their investment rate is only 5%. They only save and invest $10,000. Despite their massive income, their net worth will barely grow. Now imagine another professional earning $100,000 per year, a moderate ROCE compared to the first one. But they live frugally and aggressively save and reinvest 50% of their salary, that is $50,000, into, let's say, stock, real estate, or upgrading their own skills. That is also a reinvestment, just like how the companies upgrade their softwares and machines to remain competitive and earn more. The question is, who will create more wealth over 15 years? The second professional will leave the high earner far behind. Businesses function exactly the same way. Generating high profits on existing capital is only half the battle. Real wealth is created by what portion of those profits the business can actually reinvest back into the machine. Let us look at the first principles math of how this works. Organic earnings growth is driven by a simple, beautiful formula. Organic earnings growth is equal to ROCE times reinvestment rate. This isn't an opinion or a rule of thumb. It is a mathematical identity. Give me a few minutes to explain this. By definition, growth is simply the new earnings generated, that is delta earnings, change in earnings, divided by your starting earnings. So growth equals to change in earnings divided by earnings. And the new earnings a business generates, that is delta earnings or the change in earnings, is equal to the new capital it puts to work, that is reinvested capital, multiplied by the rate of return it earns on that capital, that is ROCE. So change in earnings is equal to the reinvested capital times the ROCE. If we plug this back into the growth equation, we get growth is equal to reinvested capital divided by earnings into ROCE. Now, if you noticed, reinvested capital divided by earnings is by definition the reinvestment rate. So the formula then beautifully simplifies to growth is equal to a reinvestment rate times ROCE. This means if a business has a spectacular ROCE of 40%, but it has no room to grow and only reinvests 5% of its profits back into the business, its organic growth rate is only 2% per year. It is a cash cow, not a compounder. Let us look at actual historical data from the LVI platform to see this engine in action. First, let's look at Colgate-Palmolive, ticker CL. Colgate is an incredible business with legendary brand power. If we look at its capital efficiency on LVI, its returns are outstanding. Its 10-year average ROCE is a massive 38.5%, and its current trailing 12-month ROCE is even higher at 41.61%. By all traditional value investing standards, this looks like the ultimate compounder. But look at the other side of the engine, the reinvestment rate. Because almost every household in the world already uses Colgate toothpaste, Colgate has very few places to reinvest its cash to build new factories or acquire new markets. Its 10-year average reinvestment rate is just 7.66%. Over the last 5 years, it is actually a negative 3.5%, meaning they are actively shrinking their capital base and returning all cash to shareholders. If we run the math, organic growth is equal to 38.5% ROCE times 7.66% reinvestment rate. That approximately comes out to be 2.95%. So Colgate is a very safe cash cow that pays a steady dividend, but its organic growth engine is practically running on empty. Now let's compare Colgate to Alphabet, ticker GOOGL. From a return perspective, Google's ROCE is actually significantly lower than Colgate's. Its 10-year average ROCE is 21.09% and its current trailing 12-month ROCE is 28.31%. But look at Google's reinvestment runway. Google has massive opportunities to deploy capital, building data centers, scaling AI infrastructure, developing fiber networks, and improving the search engine. Its 10-year average reinvestment rate is a massive 58.97%. In the trailing 12 months, it has surged to 130.46% as they aggressively invest in the AI arms race. So let us run the math for Alphabet. Organic growth is equal to 21.09% ROCE times 58.97% reinvestment rate is approximately 12.44%. So even though Google has a lower ROCE than Colgate, Google compounds its organic earnings 4 times faster because it has a massive reinvestment engine. Now a quick warning. A high reinvestment rate is not always a good thing. If a company has a low ROCE, return on capital employed, say 5%, and reinvest 100% of its profits, it will only grow at 5%. But if investors expect a 10% return on their capital, this company is actively destroying value. This is the classic growth trap, where management keeps expanding, but shareholders get poorer because the returns on that new capital are below the cost of capital. But this brings up a crucial capital allocation question. What should a company do if it generates high returns, that is ROCE, but simply runs out of internal reinvestment opportunities? Should they just hoard cash or reinvest it in low return projects? Answer is absolutely not. And this is where a strategic share buybacks come in. When a mature business like Colgate or Apple generates massive free cash flow but has no internal projects that meet their high return hurdle, they can use that cash to buy back and retire their own stock. By shrinking the total number of shares outstanding, they automatically increase the earnings per share EPS for the remaining shareholders, even if the overall net income of the business grows slowly. And this is the difference between growing the entire business, that is net income, and growing your slice of the pie, that is EPS. As long-term investors, we care about the size of our slice. So the holy grail of quality investing is to find the twin engines. A high ROC, which proves the business has a competitive moat, and second, a high reinvestment rate, which proves the business has a long runway to grow. Calculating these metrics over long time frames is tedious because standard financial sites only show you ROC for the latest year, and they almost never show you the cumulative reinvestment rate. That is why we built the LVI Key Insights engine. We automate this exact logic. We calculate ROCE by dividing operating income or EBIT by capital employed, averaged over 3, 5, and 10 years to smooth out one-time events. We track the change in capital employed over multiple years and compare it directly to the cumulative net income generated during that time to get the true reinvestment rate. LVI's business quality score checks both metrics automatically. If a company scores high on both, LVI flags it as a potential quality compounder. Now that you understand the twin engines of compounding, I want to leave you with a challenge, which I call the Apple paradox. If you go to the Apple detailed key insights page on LVI, you will find that Apple has an astronomical ROC in the range of 40 to 60%. But its calculated reinvestment rate is actually negative 6% over the last 5 and 10 years. So how can Apple be one of the most successful compounding stocks of our generation if its reinvestment rate is negative? Now think about how Apple utilizes its cash. Do they reinvest it into physical factories, or do they distribute it externally to buy back their own stock and shrink their capital base? So is Apple an internal compounder like Google, or is it what I call shareholder distributor compounder? Head over to the Apple page on LVI, analyze the metrics, and let me know your thoughts in the comments below. If you have enjoyed this first principles breakdown, make sure to like the video, subscribe to the channel, and check out letsvalueinvest.com to analyze these metrics for any stock yourself. Happy investing, and I will see you in the next one.